Yeah, hi. So recently I had written a Substack post and I got a lot of review and feedback. Basically, it was about the PE ratio. And so I tried to basically try to explain a framework of how one should look at evaluating the PE ratio. So PE ratio is something which I think we all of us use on a day-to-day basis. Whenever we look at a stock, while we can very easily understand, what the market price is, what the EPS is, the PE is something which is always a bit of an enigma for all of us. So this topic has always been, quite interesting for me to really understand, and it's taken me many years. Not that my understanding now is perfect, but whatever I've learned, over the last so many years, I'll try to share, right? So essentially, what we'll do is we'll try to cover this, in two to three different categories, right? So the first, we will look at how PE ratio is traditionally used. Then we will look at, why, a framework can really help us understand this better, right? And finally, we will try to, go through some examples and go through some questions which came to me on the Substack as well as on Twitter to try to understand, how I look at this particular ratio. So P ratio, I would say traditionally is used by people in a very static manner, right? So people have these notions that, specific set of stocks should have a specific set of P ratios. So for example, people think that uh, a P ratio of more than 40 or more than 50 is a no-go, right? So anytime you come across a stock which has a P ratio of, let's say, more than 50, it automatically gets disqualified for many investors, right? Similarly, the other side of it is people think that a P ratio of 5 or 10 or 15 is something that is undervalued, right? So I think both of these are, two extremes, and obviously both of these things are incorrect. Um so just because the PE ratio is low doesn't mean that you're going to make money in that stock, and just because the PE ratio is high doesn't mean that you're going to lose money in that particular stock, right? So this is exactly why this remains an enigma, because unlike a lot of things in other spheres, right? The idea of the PE ratio cannot be bounded to a particular formula. It cannot be, it is not something that is static, or it is not something that is absolute. Uh, it is something that keeps fluctuating depending upon several factors. And our job as investors is to really figure out, which factors are in play in the current context, and use that understanding to really come up with what sort of a PE ratio will fly, or what sort of a PE ratio will be sustained, right? So, what is my understanding of the PE ratio? So, for me, the PE ratio is basically a shorthand to get a quick check on the valuation given a specific context, right? So, this qualifier that I just said, right, given a specific context, that is very important. And like I said, the PE ratio is not static; it is an ever-changing number that changes often dramatically with the change in context, right? So again, so don't think of it as it's never used by me, at least as an absolute number. So I never think that the PE of 20 is better than a PE of 50, right? Whether the PE is high or low, or whether the PE is attractive or not, depends on several other factors, right? So this is a very important idea. I think one of the first takeaways from this video have to be that the PE is not to be evaluated in an absolute sense, but in a contextual manner, right? So let's see what factors impact the PE ratio, and really set this kind of a context. So the most important, so what we'll try to do now is, I think we'll try to go through that list that I shared on the Substack. And those of you who have not seen that post can maybe have a look at that and then come back to the video. But let's look at these list of factors, right? So the most important factor in almost, I would say 80% to 90% of the cases is growth, right? So again, a PE of 50 or 60 cannot be looked at in isolation. We have to always ask, why is the market giving it such a high PE ratio, right? So market is the sum total of the intelligence of all the participants, right? So obviously, the broader market is not stupid, right? It is not foolish. And there are times when, it goes into extremes, especially during the bullish phases, right? But let's say in a bear market, right? In a bear market also you will find, that several stocks enjoy very high P/E ratios that typically do not make sense, right? Uh, so at such point in time, we have to learn to look at both sides of the equation, right? So one side of the equation is obviously the PE ratio, and the so there are a lot of other factors that can explain why this PE ratio is high, right? So the main factor generally turns out to be growth, right? Especially above average growth, right? Uh, so there is a difference between how market evaluates a normal growth. So let's say the normal growth is about 15 to 20%, earnings growth CAGR. So a 15 to 20% earnings growth CAGR, let's say if that enjoys a PE of 20 to 25, uh, a stock that is growing at a PE of 40% or 50% will not enjoy a PE of 40 or 50, right? So a lot of people use this PEG ratio and they say that the PEG ratio should be less than one. But there is a nuance here. There's a difference between, if the PEG, if the growth is normal, which is like anywhere between 10 to 20%, then the PEG ratio formula probably holds. But if the uh, growth rates are above average, if something is growing at 40 to 50%, then suddenly there is an orbital change in how the market values those stocks. And the reason for that is companies which can grow at 40 to 50% are relatively rare, right? So you will get many companies which will probably grow at 15 to 20%, but companies which can grow at 40 to 50% for several quarters are rare. And because of that rarity, there is a demand supply imbalance, and which is why a stock growing at 40 to 50% will not be available at a PE of 40, but it can easily be available at a PE of 60 to 70 also, and still work, as long as the growth remains, right? So that is the keyword. So whenever you're dealing with high PE, high growth situations, the growth rate, right? And the growth rate is the all important factor. The moment the market feels that the growth is slowing down, you will see a very, very sharp PED rating. A very good example of this is something that happened in a stock recently called PGEL. Uh, so any stock I discuss or speak about, obviously it's not a recommendation. I'm just discussing this in the right context. So PGEL was a company that was growing at high growth rates of 40% plus, 40-50% plus. It was guiding for that kind of a continued growth rate, and suddenly, for whatever reason, the management said that the growth rates are going to come down, and maybe this year they will do only about a 20% growth rate, and you saw the way the stock crashed. Now, all this while, as long as the growth was good, it enjoyed the high PE ratio in a sustained manner for multiple quarters and in fact multiple years. Uh, Just when the growth, started to slow down, immediately a PED rating happened, right? So, so in this particular case, right, in most of the growth stocks, the PE will be determined primarily by the growth rate, and especially if the growth rate is above average. So that is something that you'll have to remember. The next point that I mentioned was the sector, right? So the type of sector also matters for the PE ratio. So, to give you an example, uh, a secular growth sector, right? Like consumer staples, consumer durables, retail, domestic MNC pharma, or businesses or sectors where the market feels that there is going to be continued growth. The growth itself may be lower, it may not be a 30-40% growth. The growth itself may be a 15 to 20% CAGR, but the market feels that the growth can continue for years and probably a decade or more, right? So those such sectors are called secular growth sectors or secular growth stocks. There, because of the surety of the growth, right? Or the probability of that 15 to 20% CAGR is very high. Such sectors typically will enjoy a relatively higher PE than compared to something else like a commodity business or something that is capex heavy or an EPC business, right? So wherever you can extend the longevity of the growth, or wherever you can feel that this is something that can grow for a long period of time, you will see that the PE ratios are typically very high. A great example of this are stocks like Avenue Supermart, stocks like Trent, right? Whereby even though the growth rates are not very high. In case of Trent, it of course was, right. So when the growth rate was high and the sector was secular growth, you get a super premium, which is what happened with Trent, right. Avenue Supermart, when it was growing at 30% CAGR, had both these factors going for it: a high growth rate and a secular growth sector. So you got a double upgrade, so to speak, of the PE ratio. But once the growth rates started to come down, the P derated, but of course, it didn't derate to a level of 20 or 30 P, right? It still remained elevated. And that is because it is a secular growth sector where the market believes that the growth is going to last for a really long time, right? The third factor that I had mentioned was basically lineage or corporate governance, right? So the ability to trust the management also plays a very big role in deciding the PE ratio, right? So gold standard managements like the Tatas or the Murugappas, right? They will always get a slightly higher valuation or a higher PE ratio than groups which with not so great corporate governance, right? And so there are three types of managements, right? So one is your so-called gold standard managements, which have demonstrated that they have can generate wealth without doing much hanky-panky in terms of how they deal with the business or how they deal with shareholders. Then there are, of course, the neutral guys, right? Who are just doing their thing. They may not be very good. They may have one or two, small blemishes on their track record. Broadly, they are okay. And of course, the third is where there are serious corporate governance issues, and those managements have proven in the past that they are not to be trusted. So if you have a very good corporate governance, you will get extra points on the PE ratio. But if your corporate governance is neutral, you may not, this factor may not matter. And if your corporate governance is bad, right, irrespective of your results, irrespective of how good the current earnings is, environment is, you will still get a low PE ratio. So a good example of this would be, management, like let's say a PC Jewelers, right? Now it seems to be turning around, in purely in terms of numbers, but if you look at the corporate governance, it has serious issues, right? So the market is not really going to trust some of these names, right? Similar names go to some of the recently listed gold players, right? Whereby the growth rates are good, the numbers are good, but the PE ratio just won't inch up, right? Because the corporate governance is not so great. If the same type of growth rate would have come in a Titan, right, it would have been a completely different story, right? So lineage or corporate governance also is one of the important factors. A related factor, the next factor is basically the leadership, right? So leadership, if a sector leader or number one or two in a sector will always enjoy a higher PE than the lower rung. So like a Titan and a Kalyan will, let's say they're number one and number two, will enjoy a much higher P ratio than a PCJ or a Senco or any of these other tier two, tier three kind of names, right? So leadership matters because obviously institutions go after leaders, and institutions will rarely invest in the lower run stocks, obviously because the liquidity is not good. And generally, it is something that will be looked, there's a risk that will be looked down upon. So institutions will generally, make a bet on a sector or a theme, and they will always try to, go after the number one or the number two in the sector, right? Uh, so more money typically chases leaders, and that is why the PE ratio of the leaders in any given sector is generally higher than the lower run. The next variable is the ROE and the ROCE, right? So the return on equity and return on capital employed. So companies which demonstrate a high ROE and high ROCE will generally get a higher PE ratio. Other factors remaining the same, right? So if you have two very good companies, you know, uh, so one of them, you both have similar growth rates, but one of them has a higher ROE or ROCE than the other one, then you can fairly expect that the one which has a better return ratios will get a higher PE ratio. Next up is, so these are some of the fundamental factors, right? I would say, they are not game changers as far as the PE ratio is concerned, but they contribute to that overall number. So ROE, ROC is something we discussed. I think longevity of growth, right? We spoke about secular growth stocks. So perceived longevity of the growth, right? So let's say defense now. Now, defense stocks may not have great growth numbers right now, or they may be very lumpy or fluctuating, but because of the perceived longevity, they will enjoy a higher PE ratio, right? Similarly, the quality of cash flow, right, is something that the market keenly watches. So you would have seen some stocks which, were enjoying a very high PE ratios because the growth was very good. But when the market sentiment changed, right, suddenly the cash flow and the quality concepts, came into play. So typically, what happens is in a bull market, the market will, focus on the two or three important variables from this list, like growth and lineage and sector leadership, right? But uh, as the bull market gets over and we get into a bear market territory, the other factors start becoming important, and especially the fundamental factors come into play when the market sentiment is bad. So the same company which was growing at the same rate in a bull market will enjoy a very high PE, but the moment the bull market gets over or the market sentiment is bad, that is when the market will start pointing out that there are fundamental issues here in terms of low ROE, ROC, the longevity of growth is not there, the cash flow is not great, and the PE ratio can crash. So the PE ratio will also change depending upon the market environment, right? Which brings me to the next point, which is popularity, right? So popularity or bull market or a hot theme or a famous investor. So all of these are things which can temporarily elevate the P, but if you're able to ride it in that phase, right, when that re-rating happens, right, a stock going from neglect to popularity, a theme that was unknown and suddenly is becoming a hot theme, right, or a famous investor enters, all of these things coming together can give a temporary boost to the P, but that only lasts till the bull market lasts, right? So that extra 20-30% of the PE that you get will only last as long as the bull market lasts, right? Finally, a new category, right? Let's say electric vehicles or recently, the rare earth or AI. So whenever a new category comes into play, even if the earnings are not there, even if the growth is not there, you will see that the PE will get re-rated. So the EPS itself will not change much. It may even degrow, but the stock will keep going up, which means what essentially is happening here is that a PE re-rating is happening. And that typically happens for new categories. So whenever new categories come in the market, there is a demand supply mismatch because let's say a lot of EV stocks came into play, right? Earlier, all these two-wheelers were there who were doing the ICE engines. Now, when the EV stocks comes into play, there are not many institutions who have an exposure to that segment. So they will go after these new category stocks. So if you look at Zomato, if you look at Paytm, all of these stocks were new categories. So when new categories come in, they will typically enjoy a P that will look a bit absurd, but that is how markets work. They will always have these kind of higher Ps than what you would see in the existing categories or the older category stocks, right? Finally, I think float, right? Again, it's a bull market concept, but float, demand supply mismatch can drive up the PE. This you can see for all the MNCs, right? So using this, you can explain why the MNCs in India enjoy such high Ps. Right? There are multiple factors that you can attribute to the MNC PE ratios. So obviously one of them is float. Obviously the lineage and corporate governance is one big factor. So even if the growth is not there, right? Just because the corporate governance is very high, it's gold standard, plus a combination of float, right? You will see that these companies will continue to enjoy a high PE. Now, if you have a great corporate governance and you have a great float, and on top of that, you get, let's say, you start getting growth suddenly, or they get into a new category which they were not in earlier, then you will see that the stock will again, move up on an expanded PE, right? So multiple factors can come into play. So what we have to really take away from this is that uh, you know uh, it is not about one factor. So for every stock that we are looking at, we have to see from this list which of the factors are really coming into play, which of the factors have a higher weightage, right? So like I said earlier, PE is something that is dynamic, right? You have to start thinking of PE as something as dynamic. It is not like if a stock is growing at this rate, then this X has to be the PE, right? PE is dynamic. PE depends on multiple factors. The factors themselves, the importance of the factors themselves changes depending upon the market environment. So you have to look at this list. Maybe there might be a couple of other items which I might have missed, which we can add later, or if somebody can tell me in the comments, we can look at that. But broadly, these are from my experience, these are the factors that typically matter. So you have to have this list in front of you. You have to have this list handy. You have to think about how exactly what factors are contributing to the PE ratio of the current stock that you are analyzing. Because once you have that information, your decision making will really improve, because you really know why this stock is valued the way it is, right? Is it growth? Is it corporate governance? Is it the longevity? Is it the fundamentals? Is it the float? Is it a new category? So what is driving the PE ratio? If you understand that, then your decision making with respect to whether buying the stock, holding the stock, selling the stock will improve significantly, right? And finally, there are certain stocks which are, distorted PEs, right? The cyclical and the turnaround types. So we'll not really get into that, but you have to know, right? So sometimes, when cyclicals are doing really well, you'll see that the PE ratios are very low. And sometimes in case of turnarounds and all, you will see that the PE ratios look absurd. Well, the important thing to understand here is, not to just look at the PE ratio and disregard those stocks, but understand what's going on there, right? So is it a turnaround? If it's a turnaround, then, you will see PE ratios of 100, 200, 500. But you have to realize that those PE ratios don't make sense, because the earnings itself, is undergoing a major change, right? So something that was loss making, the earnings, now it has become, profitable. Now, if the earnings can potentially go up 5x or 10x, right? So the PE ratio that you are analyzing has to be analyzed in that context, right? So these were some of the key factors that I thought I should probably spend a little bit more time on, because there was a lot of interest in this topic. Uh, so if you have any questions, if you have any comments, with respect to this, I can probably do a follow-up video on this. Uh, but that was about this particular framework. Now coming to the questions, right? So a lot of people ask, in the comments in the post itself on Twitter, a lot of you emailed me. So there were a host of questions. I'll try to cover some of them. So some people, so what I'd done in the post is I'd shared a list of winners, and I had just demonstrated, how high the PE ratio was. And in spite of the high PE ratios, they were some of the best winners over a 3 months, 6 months, 12-month period, right? So some people ask if the PE ratio was low to start with, right? So the answer is no, the PE ratio was not low to start with, right? The PE ratio, so let's say something has a PE ratio of 60, let's say it has make a 50% move, right? So its starting PE ratio was 40. So traditionally speaking, even 40 is thought of as something that is expensive, right? But the idea here is not whether the PE ratios were low to start with. The idea here is that if you the PE ratio in itself, that number in itself, right, it's given way too much importance, but that number is very, very nuanced. The understanding of that number, is something that you have to do on a case by case basis, on a contextual basis, right? So a P ratio like I said, a P ratio of 50 may be a better than a P ratio of 10, right? Which is counterintuitive to how a lot of people think, but that is the reality, right? So just because a P ratio is high, do not disregard that stock or do not discard that stock. That was my idea of sharing that list. It was not to show you that only high PE stocks make money. The idea of sharing that list was that just because the PE is high, don't discard the stock, right? There will be instances where because the PE is high, you might lose money, right? But you will lose money not because the PE was high, but because some of the other factors changed. You know, so somebody who owned, let's say, a PGEL or a Dixon or any of these names, right? The PE ratio was high for years together. No, so anybody who disregarded these stocks purely on PE ratios missed that opportunity. But when the So, but now the stocks have corrected. Now, the reason for that correction is not that the PE ratio was high, right? The reason is that the growth rates have come down. So, attributing, fallings of the stocks to high PE ratios is not a mature approach. There is a reason behind the PE ratios, and that is what we have to try to understand. So that is what I'm trying to, get to with the help of this video, right? So I think so my hope is that all of you are better placed to make sense of the PE ratio, and I've understood that it's something that is very contextual. It is ever changing as the above parameters that we discussed change, right? And I had some other questions. So I'd mentioned somewhere that the PE ratio, the rule of thumb that I use is that the PE ratio should be less than twice the top line growth, right? So I don't look at PE ratio in absolute sense, but I always compare it to the growth rate of the company. Generally, the PE ratio is compared to the bottom line or the earnings. The reason why I said top line growth is because it gives you a little bit more margin of safety, because top line growth, because the bottom line growth can be temporary, but a top line growth can sometimes continue for much longer. So a PE ratio of less than twice the top line growth is a rule of thumb that I use. There might be stocks that I still buy where that number might be higher. But like I said, every stock has to be evaluated individually on its own context. But this is a rule of a broad rule of thumb, right? So I think that's about it. If you have any questions that you would want me to answer about this particular topic, please put it in the comments and I'll try to answer there. Or if you want me to answer anything specifically about the markets around practical issues or concepts, then you can please mention that. I've already got a list of things that I would want to, create some videos on. The focus being, I want to focus on practical issues, issues which are not spoken about in any books, right? So I don't want to go after theoretical, concepts. So this was a great example of that, right? So PE ratio is always an enigma. People don't really know how to think about it. So I have shared my understanding of the same. So if there are any other topics, which are more nuanced or which are more practical issues that you face, then you can leave it in the comments and I'll try to answer that. So thank you so much.